So I really hope that the sound stays this time, because I've been playing with this for an hour now and the sound is just going off. Okay, guys, this is an experiment that we're doing. It's a technical analysis, strictly technical analysis on the S&P 500, SPX. And what I'm trying to prove by this technical analysis is I'm trying to show that only using technical analysis can yield really bad results. My thesis is that because technical analysis uses lagging data, that means that it uses the data of the trading after the fact. Okay, both indicators, both candles. It basically creates a situation where a single observation, a sudden reversal, a sudden downside can completely change the technical analysis, can completely change the thesis. It can throw you off completely from your current trade, and it will basically change the direction of the index, sort of, and you will not be able to exit without pretty big losses. And we also want to see, I've not done the analysis before. I'm actually doing it kind of live here. So we also want to see if there were any signs that would warn us, or if there were any signs that actually, something of the sort that happened on Friday and Thursday, that means that this sudden reversal, if we could actually predict that and prepare for something like that using technical analysis. So I also know that if this video is going to be like 35 minutes, 40 minutes, nobody's gonna watch that. Come on, let's be honest. So I will try to do it maybe 20 minutes max. I'll just try to go through it pretty fast and make it kind of simple for everybody. So this is the monthly chart of the SPX. I've cut from it the March month, because we don't want to look at things after the fact. We want to see the technicals how they were before. And we're going to look at the monthly, the weekly, and the daily chart. Also, the intraday chart we're going to look, because somebody asked to use a volume weighted average price, and it works more on the intraday charts rather than the daily chart. It actually gives you signals intraday more than daily. So this is the monthly chart of the SPX, and let's look at it. These are the Bollinger Bands. Okay, because the price is between the median of the Bollinger Bands and the lower Bollinger Band, it means that the S&P 500 is bearish through the Bollinger Bands. It also got some kind of a rejection here from the median Bollinger Band. These are the moving averages, 250 and 20. Now, look, the moving averages on the larger charts, the monthly or the weekly, are disputed. There are people who say that they don't mean anything, people who say that they mean everything. The reason why it's disputed is because, the 20-day moving average, for example, signifies 20 days. 20 trading days is exactly, or almost exactly, a month of trading. So it kind of shows you some kind of a trend that happened in 20 days. 50 is almost like a quarter, shows you a quarterly trend. The 200 is a yearly trend. So they should, hypothetically, they should not mean anything on 20 month, for example, on 20 or 50 month, because what are 20 months? What are 50 months? No, there are no real, time frames. They don't show you anything, not even a decade, right? But there are people who, trade based upon them. I'm pretty sure that there are algos that actually react to them. So we will take them as they are. That means that we will assume there is a reaction to these moving averages, even on the monthly, on the weekly chart, not on the daily. So we see that there is a bounce on the 20-month chart. 20-month moving average, sorry, there is some kind of a bounce. We found, in October we found support there, and we bounced from there. So because the price is not below any of the moving averages, it means that through the moving averages on the monthly, the S&P 500 is bullish. Now let us look at the indicators. RSI indicator. On the RSI indicator, basically from its top around August 21, or basically a lower high on December 21, so far, the chart is bearish through the RSI. There are people who would say that this is a bit of a no man's land, but it has started a path to the downside and is yet to complete it on the monthly chart. We look at the MACD. The MACD is actually bullish, or we could say turning bullish. It is bearish because the moving averages have crossed before in March 22, and they're moving down. However, both averages are above the zero line. It means that they are positive. The histogram is showing us that the monthly momentum, the monthly bearish momentum on the S&P is weakening. So looking at the MACD, it is still bearish, but we get early signs of a bullish reversal actually. When we look at the stochastic is bullish. It has found a double bottom here, okay? October and June. It means that it found the double bottom, it's moving higher, it started a new path, signaling that the stochastic is a faster momentum than the RSI. It reacts much more to the price movement. So the stochastic is signaling us that so far there is a bullish momentum on the monthly chart to the upside. Now, let's add the month of March. Obviously, it is only just started, but I will show you how 2 days can change the technicals and make them much more favorable towards one side. And it's funny because what if in the end we end up, even if we go up, but what happens if by the end of March we still end with a red candle? You see, the problem is that, and this is my criticism, that these things, they influence your trading. However, the data is gonna always change, and you don't really know until after the fact that it is actually changed. So we're gonna add the March month. This is the March month we've added, right? And we see that suddenly the RSI is up. It's actually signaling us some kind of a divergence here, right? Where we see that since September, December, February, the price is going up and the RSI is going up, so it supports this reversal we had in the index to the upside since September, October, basically. The MACD starts to turn up, and the March column is smaller than the February column, signaling that the bearish momentum is further weakening. By only basically 2-3 days of trading, it's actually pretty much becoming more bullish pretty fast, right? And what we have here on the stochastic is a slip. Okay, a slip means it was going to cross into the bearish side, and then suddenly it surged to the upside, signaling further momentum. So suddenly, even the stochastic is looking much more bullish, and we're talking about only 2 days of upside have been able to create this reversal in the stochastic where it suddenly is much, much more bullish than we'd seen before, right? If we just look at the chart itself. Okay, now let us go to the weekly chart and look how it has changed, okay? So I'm gonna replay, I'm gonna cut the last week out so we can actually see how the technicals looked. So on the weekly chart, the price is between the upper band of the Bollinger Bands and the median of the Bollinger Bands. It was able to hold above the median Bollinger Bands. It means that through the Bollinger Bands on the weekly chart, the S&P 500 is bullish. Okay? The S&P 500 is above the 200-week moving average, but closed below the 20 and the 50-week moving average. Moreover, the 20-week and the 50-week moving average looks like they're going to cross. That means that so far, looking at this chart, the S&P 500 is bearish through the moving averages, largely. Okay, that means that the moving averages are basically saying that it has a good chance to retest the 200-week moving average at least, which is a 5.5% downside furthermore. Now, we have this trend line. It actually looks more accurate on the daily chart, but you could kind of see, even on the weekly chart, that there's some kind of an uptrend here. So the trend line is basically here, and it's saying that we might have a bounce. Okay, so this is, for example, an indicator that shows that we might have some kind of a reversal here. The trend maybe it will continue to the upside. Who knows? Okay, let's look at the indicators. So I'm gonna remove this. So on the weekly chart, the RSI, okay, we see here something that we saw on the monthly, but we see that we have basically a divergence. Now, this divergence is supporting the price, right? As the price goes up, the RSI makes higher highs, and what's most importantly is it makes higher lows. So as long as it is making higher lows, it is actually supporting the upside in the S&P 500 on the weekly chart. So though it is curled up to the downside, it crossed the 50 line, we could still say that because it is a higher low, it still supports an upside, though it is turning bearish, right? So that's the RSI. We look at the MACD on the weekly chart, we see that the histograms are getting smaller. Moreover, we have here a kind of hidden divergence where the histograms in November are larger than the histograms in January, but the price is actually higher. Okay, we had a higher price in January than in November. And the MACD is closing in on a crossing, or at least a retest between these two moving averages. So it's still positive. Okay, actually the lower moving average is going to go positive soon, but we kind of still see that there is a good chance we will have here some kind of a retest or a slowdown in the MACD. That means that it's trying to tell us that we might have some kind of a downside and a retest to this bullish trend that has been going on pretty much since, October. The stochastic is bearish on the weekly chart. It says that on the weekly chart we had started a new wave of down momentum. So looking at the stochastic, it simply says that we have a momentum to the downside on the weekly chart. It has started, it is going, and it should bring us further more down. At least this is how it is portrayed on the stochastic weekly. Now, let's add this week that was, this first week of March, and see how it changed the technicals. So first of all, we do have a closing above the moving average, meaning that right now, again, the S&P 500 is bullish, completely bullish for the moving averages. We had some kind of interaction with the trend line, as you are seeing. We had some reversal from this trend line. It means that the S&P 500 is keeping the bullish trend that is portrayed by the trend line. Furthermore, the RSI has been able to make a higher low, indicating that it will attempt to make a higher high supporting the bullish trend in the S&P 500. The MACD, though the histograms kept decreasing, as if you're seeing here, the MACD churned a bit to the upside, signaling that maybe it will go higher. But we'll still look at, and by the way, the moving average, the lower moving average actually crossed to the positive territory. We'll still look at the MACD as a kind of a bearish signal because, perhaps the bullish trend has to be tested in a way on the MACD, but it starts to go up. So if we start seeing the histograms actually moving to the upside, that would be a bear killer basically, because that means that there will be no retest. The trend is going to keep being bullish, right? Bollinger Bands unchanged, of course, right? If we look at the stochastic, it's unchanged. It basically churned up a bit, more to the side. Still signifies that there is, a fast momentum to the downside on a weekly, but not as decisive maybe as it was before. But I'd say that it's still pretty bearish, the stochastic. Okay. But again, what we're seeing is a single observation was basically able to change some of the technicals to look more bullish than before. And actually looking at the weekly chart, it looks pretty bullish. Okay, it looks pretty bullish actually, especially with this reversal. So we're gonna now look at the daily chart and then the hourly chart to see the mega pumps on Friday, the vertical rallies. Okay, and we are going to see everything, and okay, we'll come to a conclusion later. Okay, I myself, I've said before I made this analysis that I've not looked at the TA before. Okay, I've not looked at it. I'm doing it pretty much live right now. So I might myself be surprised. Maybe the technical analysis is actually extremely bullish and I didn't know that. And that would be a really funny thing, because most of the people in the chat that use technical analysis say that the index is actually really bearish. But look, we've looked at the monthly chart so far, right? We've looked at the weekly chart. Things are looking pretty bullish. Okay? Let's look at the daily chart, okay? The daily chart is important because, obviously in the bear market, the daily chart is leading. It's leading because, again, short-term movements can completely change the technicals, as I've been trying to show here. So maybe the daily chart will offer more clues. Let's look at the daily chart. Okay, this is the daily chart of the S&P 500. And wait just a second. No. This is the daily chart of the S&P 500. Okay. So the price remains between the lower band of the Bollinger Band and the median of the Bollinger Band and the lower band of the Bollinger Band, though it kind of sort of reversed from the lower band, but still it's between them. That means that on the daily chart, the S&P 500 is bearish through the Bollinger Bands. We saw some positive reaction to this trend line that I've drawn here since the October bottom. So we could say that there was a successful retest so far of the trend line. That means that through this trend line, the S&P 500 for now keeps its bullish trend to the upside. Okay. If you look at the moving averages, okay, the 200-day moving average is above the 20, above the 50, which means that the trend is still bearish. However, the price closed above the moving averages. The 20-day moving average, for the first time, by the way, since April 22, is going to cross the 200-day moving average to the upside. The 50 is also curling a bit up, okay? But I won't speculate on it right now, okay? Let's not speculate. Let's say that so far, the S&P 500, because it's above the 20-day moving average and above the 50, it's bullish on the daily chart for the moving averages, but because the 200 is still above every other moving average, it's still sort of considered in the bearish trend, okay? So it's a bit of neutral. It kind of says one thing and then the other. So let's say that the moving averages are sort of neutral. We're waiting for some kind of resolve of this situation in the coming days. Either they will turn down each and every one of them, or they will cross to the upside, signaling a new bullish trend through the moving averages in the stock market, in the S&P 500. Now let's look at the RSI. Okay, and I will remove this trend line because it's on the weekly and monthly. On the RSI, the RSI has been able to, I don't want to call it a higher low, but the RSI was able to create a reversal to the upside, signaling that we had some kind of a reversal in the stock market. Okay, the stochastic, it was oversold before. So it was actually saying that we should have a bounce here. Okay, we should have expected the momentum to turn to the upside, and indeed, the momentum is turned to the upside, and the stochastic is bullish through the daily chart. It signals a new fast momentum to the upside on the daily of the S&P 500. Okay, let's look at the MACD. The MACD, the averages are, one negative, one positive, but they're really close to the zero line. Okay, the histograms are actually going down, signaling that the moving averages are probably going to make some kind of a meeting, a retest, or something like that. But it's actually looking bullish. Okay, the moving average was able to cross here. Okay, sorry, it was able to curl up, and it actually is looking pretty bullish right now. That there will be at least a retest to this short-term bearish momentum that started on the daily chart, and maybe even a crossing that will signal a new bullish momentum on the daily chart. Okay, now I did a bit of a mistake here. Instead of first cutting those two last days, I did the opposite. I actually analyzed the finalized product. So let's cut these two last days and see how the technicals looked before on the opening, let's say, of Thursday. How they looked, what did they say to us? Okay, we cut these 2 days, and this is what we get. So through the moving averages, the S&P 500 is suddenly bearish. Bollinger Bands still bearish, but the trend line held, still signaling that there is some kind of a potential of a bounce here after testing the trend line. Okay, the RSI, it's bearish. It signals us that the bearish momentum is continuing to the downside. Okay, MACD, the histograms are getting a bit smaller, but we don't see a clear trend, of the histograms really decreasing in their length so far. And both moving averages are moving down on pretty steep slope. That means that through the MACD, the S&P 500 is pretty bearish. Okay. The stochastic is the only one that is actually warning us about some kind of oversold conditions, that maybe we will have here a reversal on the momentum part, on the fast momentum part of the S&P 500. It is actually bullish because technically it's actually bearish because it's oversold and it can stay down, right? But it does warn us of some kind of maybe a danger of a reversal because it's oversold on the stochastic. But as we see that if we roll those 2 days, just 2 days of trading, suddenly the technicals look incredibly more bearish. Actually, almost every technical other than the trend line and the stochastic on the daily chart is bearish. Okay? we're looking at pretty much almost an absolutely bearish index on the daily chart. And when we add, just look at this, when we add those 2 days, okay, suddenly those technicals capitulated faster than the bears on Friday. So, I mean, this is the danger. This is what I'm trying to prove, that, you know, 2 observations, 2 fast days of moving to the upside, it suddenly basically told you that, well, you thought it was bearish, we lied, we made it was a manipulation, we manipulated you to the downside, we told you this is going to crash, and it never happened. Okay, this is the danger that I was trying to warn from by technical analysis, where 2 days were enough to trap you, and now basically the technicals are betraying you and they're saying, you know what, this looks like really it's pretty bullish. This is bullshit, guys. You can't make a consistent strategy if you have those stuff. I mean, well, maybe if it was a bull market, you know, and the movement in the S&P 500 wasn't so extreme, these technicals would have worked much better because, you know, they would not trap you like this. But here is a situation where suddenly there was a sudden reversal after a gap down of almost 3% in the S&P 500. Suddenly all these technicals are telling you, well, you should go bullish. Now, I know, if we analyze the monthly chart, we saw that it is pretty bullish on the monthly chart, right? Even though the technicals there as well changed because of those 2 days, the beginning of March. We look at the weekly chart, we saw the same. The technicals have changed because of 2 daily observations. Are you fucking kidding me? You want to tell me that the monthly chart was changed because of 2 days? This is the danger. This is why I'm trying to explain that the lagging data, because all the indicators, the candles themselves, they show you data after the fact, okay? They open up to a situation where a single observation or a few observations that are out of the norm. For example, like the vertical rally we have here was the start of the vertical rally. Completely changed the thesis. If something was looking, let's say, neutral to bearish before, now it's looking pretty bullish, which is a joke. Now, let's go to the hourly chart. I'll enable the VWAP. Okay. I'll enable the VWAP. We're going to see if maybe, you know, on the hourly chart we had some kind of indication that a huge short squeeze was coming. So, basically, I will remove the normal moving averages on here. I will remove the Bollinger Bands. We're just gonna look at the VWAP, right? We have the median line, we have the green line, which is the upper part, and the red line, which is the lower part, right? And actually, I don't know, maybe the hourly chart is not good enough. It doesn't show enough interactions. I guess we could see here on the, let's say, 15 minutes chart, okay? When we open up the 15 minutes chart, I'm also gonna be showing you something which I'm critical of also of the, you know, indicators on the intraday. We're opening up the 15 minutes chart, okay? And we're looking at the VWAP, okay? And, well, just by looking at it, I guess, look, I'm gonna say, to be honest, I never really used the VWAP, so I was looking a bit how to read on it, how to read the chart itself and all of that stuff. Basically, it, you know, once, if the chart is basically crossing the red line, it means that it's pretty bearish for the volume weighted average. You know, it kind of acts, I guess it acts like a bit of a kind of a Bollinger Band, where if it is unable to pass the median, it will probably test the lower, or if it is unable to break the median, it will test the higher, maybe climb a bit higher than that, right? So if we look at the 15 minutes chart, we see that after the gap down, there was some kind of a bit of time at the beginning where there was indecision, but then the S&P 500 was able to stay above the median line. It tested it here, and it basically just zoomed to the upside. Here on Friday's start, we had a chance perhaps to go to the downside. We had some kind of a down movement, but once we failed, basically it signaled that perhaps we're going to go to the upside, and Friday squeezed since then for 1% to the upside. So the VWAP, I guess, helps you intraday. That you could see here that a hold here was bullish, and perhaps you could have entered the trade to the bullish side, maybe to the upside, and rolled it up. Here intraday as well, perhaps as you've seen this hold, you could have tried to enter bullish here, and again, it would have rolled the vertical rally to the upside. So from what it looks like, if you're trading intraday, the VWAP actually does help you, right? It does have good interactions. We have situations here where you have crazy candles, right? Where you don't see a lot of interaction here. Perhaps you could avoid taking a trade right here. I mean, from what I'm seeing right now on the daily chart, that kind of jumps and changes. But I guess whoever trades intraday, 5 minutes chart, 15 minutes chart, maybe can use it much better than I am. Maybe knows how to configure it much better and can really, intraday use it really well. But to be honest, we're trying to focus more on the monthly, weekly, daily, to have some kind of a, I guess, idea where the S&P 500 is going to go further from here. Okay, what are the chances of a gap up? What are the chances of seeing not the chances, but the probability, right? What is the probability of seeing a higher price next week? Stuff like that. Now, interestingly enough, I'm gonna configure here the momentum indicators, the stochastic and the RSI, so they would fit a bit more of an intraday setting. But I'm also gonna show you something about them, which is funny, right? So RSI goes from 13 to 9 to reflect better the faster moving of the intraday prices, and the stochastic is going to go to 14.55 longer period to try and kind of filter out some noise. MACD, I don't know how useful it is intraday. I wasn't really using it, and even when I was trading using technicals, I wasn't really using MACD intraday. It's maybe useful on the higher charts, like the 4 hours or maybe the hourly, but on the 15 minutes chart, I'm not sure if it's that usable. But what we're seeing, okay, through the moving averages, through the RSIs, basically all of Friday, right? Since 9 p.m. in my time, it's basically 2 hours before the close on Thursday. The RSI is crossed into extreme overbought condition on the 15 minutes chart. It has remained overbought throughout all of Friday, and it did not stop the index at all from going to the upside. And what it signifies is that people who trade the momentum indicators in the intraday are not in control of the market. The buying on Friday and on Thursday was not done through technical analysis. It had other kind of reason behind it. Perhaps short covering, perhaps market maker buying. But these are people who was buying, these are people who completely disregard technical analysis. Because if they were strictly technical analysts, they would not have bought when RSI is so extended. I'll show you as well the 1 hour chart. But they would not have bought if the RSI is so extended on the 15 minutes. Right? They would have tried to wait maybe for an hour extra. Maybe the price would have come down, I don't know, maybe a third of a percent. But they bought, they had no problems. That means that they have completely different calculations. If we look at the MACD, it is crossed basically since almost again 9 p.m. for me is 2 hours before the close on Friday. And yet the price moved higher, stayed, and was able to consolidate, let's say, to the upside. Same, same for the stochastic, which is a faster moving average than the RSI, signifies pretty big overbought conditions, and yet the market keeps churning to the upside, and nobody cares about these technical indicators on the intraday. Let's look at the hourly chart, and then we probably will wrap it up and make some kind of a conclusion. Which, by the way, I'm surprised. Okay, but that's for the conclusion. That's for the conclusion itself. Look at the hourly chart. Okay, we see this insane vertical rally. We like vertical rallies in this chat, right? We know how to make money on vertical rallies. Okay, it's just me trying to trigger bears in the chat. But again, of course, when there is the trend line on the daily chart, in intraday it can pass it and bounce above it for long time. There aren't really interactions that you could track to the 15 minutes chart even. But on the daily chart it does look well. We see that we recapture the trend line. Okay, the volume weighted average was actually able to produce some kind of a breakout here. So I guess that people who trade intraday, maybe they went long with it. Maybe they actually rode the gap up on the Friday and the whole pump to the upside. I'm not sure this is whoever trades really using this indicator perhaps knows if it was useful or if it was not useful. Look at the RSI, man. It's what is this? Is it a peace in the whole world? Was worldwide peace declared that there's so much buying on the RSI? No, but the RSI is super overextended, and yet it's overextended since when? It's overextended since pretty much the close, right? The open on Friday. It was already pretty insanely overextended, and yet the market not only gapped up, it kept churning to the upside. It means that the people who are buying, the buying on Friday, the buying on Thursday, is not done by technical people. Okay, it's not done by technical people at all. At all. If you actually want to roll this pump to the downside, we'll try it. But let's see, the MACD is just blasted to the upside. Starts to signal a bit of a weakness here, we'll see. And the stochastic blasted to the upside on the hourly chart. Vertical rally, nothing to see here. Basically extremely overextended. People who use stochastic know it does not move above 100 pretty much. It's at 98.15 and 97. The other one is the other moving average is at 97.24. So extremely extended to the upside, and yet the market keeps moving up. What the fuck is going on, right? Now, if you want to remove the pump, we will come to. It was kind of towards the end of Thursday that the pump started. We come, to maybe 1 or 2 candles before the pump started. We look at this, okay? If there was some kind of a warning sign that maybe there will be a big reversal to the upside. So it looks to me that because this candle closed between the median and the upper band of the volume weighted average, it does warn that maybe we can have some upside here. Okay, we see that the price has made lower price, but the RSI on the hourly is actually a bit of making a divergence here, which means that yes, there is some kind of a warning that maybe it will go higher here, right? The MACD actually showing a bit of a slowing momentum to the downside. looks like it's going to cross, so there was a bit of a warning here as well. And the stochastic RSI is actually looking bullish. It's gonna cross to the upside. It's gonna cross between the moving averages. From all the indicators, actually the stochastic is the faster one. It's actually saying yes, we're probably going to see some upward movement here. So on the intraday, before the pump started, they indeed kind of were warning that yes, perhaps there will be an upside here. The question is really, did you expect to see such upside as actually it ended up being? I think not. Maybe, they were good enough to tell you that, okay, if you are bear because the gap down kind of failed, maybe you should exit here, take profits, or kind of protect the trades, who knows? So maybe they actually intraday on the hourly chart, they were telling you a bit of, to get prepared, maybe we can have a bit of a reversal here. But they were definitely not telling you that it will be such an aggressive reversal. And again, if we roll it further, right, we see that they're extremely overextended and the market doesn't give a shit. The market doesn't give a fuck. It just goes up and up and up. Okay? It basically forgot what technicals are. It just keeps churning to the upside. Now look, to warp it up, okay? I'm actually surprised. I'm actually surprised because I found that on the monthly chart, the S&P 500 looks bullish. On the weekly chart, the S&P 500 looks bullish. On the daily chart, it was bearish, but it kind of, made a reversal, and now it's looking a bit more bullish. I wouldn't say it's completely bullish on the daily chart. Looks a bit more bullish, but, if you take together the whole analysis, the monthly chart, the weekly chart, they will tilt you to the bullish side. So I want to ask you this question then. People who are technical analysts in the chat are saying that the S&P 500 is bearish. But through this technical analysis, and I've done it with you first time, I've not looked at the technicals before, we see that it's bullish. So does that mean that the people who are technical analysts in the chat should be all in buying here? It looks like this if you look at the let's say overall technical analysis that we'd made. So this is pretty interesting to me. It's pretty funny. It's surprising because we had seen that it's bullish. It's super bullish. Well, maybe I'm a bit of exaggerating, but it's bullish. Okay, it's bullish on the monthly. It's bullish on the weekly, pretty much. Okay, so it's telling us buy, right? Look, to wrap it up, I think that I've shown you, okay, that 2 days, just 2 days, can change charts that perhaps beforehand were neutral to bearish to look bullish, and charts that were, same, let's say they were bullish to look even more bullish, even more tilted to the upside. And I've shown you here that when there is short covering, when there is buying that is tied to options, the intraday at least, the indicators stop working. They stop giving you credible signals to the downside or to the upside or some kind of even no relief. Okay, even no relief to the downside, no mercy at sight in these vertical rallies. Okay? So to warp it up again, I'm pretty surprised. The upside is actually seen here on the technical part. It tells you forget about the fundamentals. S&P to 500 to 6,000 by year end, right? But it does signal an upside, that we have not only an upside left, but we're not really seeing any downside that can change that. And it tells you that perhaps the S&P 500 will make a higher high in this rally. That means that maybe it will surpass the high from August, maybe not, but it tells you that there is a good probability for the technicals that 4,184, which was the current high, right? Actually, on the SPX, somehow it's almost 4,200, but let's say that 4,200, okay? It basically tells you that 4,200 was perhaps not the high of this rally. That's what the technicals are so far suggesting. And we've seen that they are bullish, that the RSI especially is creating you these divergences where as the price goes higher, it also makes higher lows, signaling that there aren't bearish divergences there. Okay, so I am surprised. I thought that the technicals are going to be super bearish when the price goes up in their face. In reality, they're actually bullish. So in this light, though this video is not a financial advice, but in this light, the advice that you are given by the technicals, if you look at them through this, through my eyes at least, is buy, and blood shall rain upon all those who oppose me, right? Like the Jim Cramer meme, the famous Jim Cramer meme. So I'm ending this recording. It actually took me 46 minutes. I thought it would be a bit, I don't know, I wanted to do it at 20. But I guess that to show everything, to really prove certain points, that observations can change the technicals really fast, that the technicals are actually bullish. I myself are surprised, so I guess it takes time. We are closing pretty much almost on the 50 minutes here. I guess not everybody is gonna watch it to the end, not everybody is gonna watch the whole video. But what is important is, even if you just look at the weekly, or even if you just look at the monthly, or even if you just look at the daily, you see how really what I try to prove is the technicals will change after the index. They will not predict the future, but the index will tell them what to do, not the other way around. And in my opinion, when you look at the technical community, a lot of people there think that the technical somehow can change the index. Well, the opposite is true. The technicals, in my opinion, remain a lagging indicator to what is happening in the stock market. And that is their biggest disadvantage, and why I think that at least in this bear market, they are not a sustainable strategy. And over the bear market, you are going to lose all your money if you trade them, and only them. Thank you for watching and listening.